Good evening, everybody. Ethan here from Investing Note. Thank you for attending this evening's webinar. Let's give all our attendees just a few more minutes. While they stroll in. Hope everybody is doing well and had your dinner ready. Okay. Awesome. Just give us a few minutes. And today's speaker, we have Mr. Ryan Tan. Ryan, you can say hi.
Hello, everyone.
Yep. Okay, just give us, 1 or 2 minutes more while the attendees are logging in. Awesome. Of course, today's topic is how investors can beat the market tomorrow. And of course, today we have a portfolio manager, and we're going to ask him how exactly he does it. All right. Okay, 1 more minute. Okay, guys, if you have any questions, please put it in the Q&A section in Zoom, okay? All right. Then we'll leave the Q&A all the way to the back. Okay. All right. The time now is 8:02. Let's start. All right. Hello, everybody. Good evening. My name is Ethan from Investing Note. And today, the topic, the agenda is how investors can actually beat the market tomorrow by asking a portfolio manager today. So, of course, today's webinar, we have some disclaimers, right? Okay, this webinar standard is not a recommendation, and it's all the procedures protocols. Do take some time to read it. All right. So without further ado, I'd like to introduce the special guest for today, Mr. Ryan Tan. And Ryan has over 25 years of investment experience in this field. Ryan, could you share a little bit more about yourself to the audience?
Yeah, thanks, Ethan. Thanks, everyone. Thanks for having me tonight. Good evening, everyone. My name is Ryan Tan. I'm a MAS licensed fund manager, and thanks for joining me today. The purpose of today's webinar is to share some of my understanding about investing. Everyone has their own method on investing. There's no right or wrong. If it works for you, mine is just another method. Before we start, let me do a quick introduction of myself. Yeah, I started in investment when I was in JC, and since then I've accumulated about 25 years of investment experience. I graduated from NTU with a degree in mechanical engineering and was working in a few MNCs before my fund manager role. During my work as an engineer, I have first-hand experience of the whole electronic supply chain, from semiconductor to component packaging to final product assembly. This knowledge will eventually help me in my work as a fund manager. In 2012, I joined Phillip Securities under one of the pro trader scheme to invest mainly for myself, and I obtained a fund manager license in 2017.
Wow, Ryan. So, earlier you said you started in JC. Well, that's 18 years old. When I was 18, I was still, studying hard for my A-levels. So I think the next question I'd like to ask you is, what is your investment philosophy as a portfolio manager?
Definitely. These are some of my key investment strategy, right? My investment is for the long term. It's not about speculating over short-term trading. Key focus is on understanding and identifying global and future trends. It's based on extensive research on both quantitative and qualitative analysis, and is centered on proven business models. And typically, these are the larger blue chip companies.
Wow, I think it's extremely important for portfolio managers like yourself to have, key investing principles, right? So, given your expertise and experience, right, this is the part where you should share with us your track record, Ryan. Are you comfortable we share that?
Sure, Ethan. So for the last 3
Wow.
years plus, right, till end of 2020, my average performance is about 42% per year compounded. My last year performance is about 160%. Total return for the last 3 years, 4 months is about 234%. So all my clients' account are in profit as of December 2020, regardless of when they joined in the last 3 years. Although each client portfolio is constructed slightly differently, depending on the time they join, but as the performance displayed here is a summation of all the assets under my care, therefore the performance is indicative of the overall performance under me. So these are the screenshots of some of my clients' portfolio account as of February. For example, client A, who joined me about 3 years, 5 months ago, she invested about 1.9 million, and the total profit in that time frame is about 4.6 million. So the total return is about 243%. The actual returns are actually higher as the invested amount is not a lump sum from the start. So for client B, return is about 164% for 1 year, 5 months. And for client C, it's about 168% for 11 months of investment. So why am I showing this result? Actually, it's not to show the returns, but to show it doesn't matter whether you joined 3 years ago or recently. Given time, investing in the right fundamental stocks will be able to help everyone.
Wow, with this slide actually got me going. Wow, it is really stellar returns, Ryan. That's great, right? So let's dive down into today's agenda for the evening, right? So I think the very first part will be taking one step back to actually understand equity investment, right? The
Yeah,
second
definitely.
part would be why Ryan as a portfolio manager would prefer equities out of all asset classes. Next, we'll be talking about disruptive technologies and growth and how exactly portfolio managers like himself pick the right companies. Then we will move on to actually Ryan's belief in that right now is actually the golden era of investing. Last but not least, we'll have a Q&A at the end of the webinar. All right. So dear attendees, please put your questions in the Q&A section below. All right. Thank you. The time is yours, Ryan.
Yeah, thanks, Ethan. So pardon me, as some of you might be experienced investors, but I would like to start with the very fundamental basis of equity investing to highlight my main investment philosophy. So to me, equities are made up of real business and perceptions. So what's the real world and businesses of equity? So these are Apple products. These are Apple growth through the years. And these are Apple global retail presence around the world. So to me, these are real world and businesses. And what is perception? So to me, this is perception. The stock chart or the stock price is a perception. Why so, right? Every day, you have all these participants in the market, and they trade in different quantities for various reasons, and sometimes just due to emotion. And what plots the chart? Actually, is the majority, right? The volume plots the chart. So is the majority always right? Right? The herd in herd mentality is also the majority. The stock price of stock fluctuate every day, but the company fundamental does not. So basically, a summation of opinion doesn't lead you to much conclusion of how well a company will do. The price of a stock ultimately follows the actual performance of the company in the real world. It's not the other way around. So how do we map the real world and business into the stock chart? It's actually just a dot. It should be only a dot after we calculate the fair value of the company. And preferably, the dot should be outside the chart, as it indicates that the value of the company is much higher in the longer time frame. Once you are able to calculate the fair value of the company, it'll be obvious what is the right thing to do at each point of time. When the stock price of a company drops and gets further from our fair value calculation, the more we buy. This is versus selling when prices hit stop loss limit or when the chart is telling you there is a downtrend. That is why we normally do the opposite of what the chart is telling you once we identify the right company.
Wow, Ryan, I think that's a very good point, right? So with that being said, can you share with us what's your key approach in investing?
Definitely, Ethan. Yeah. So if I can select a slide on what is the most important to tonight, this will be the slide. Yeah. To me, the most important thing about investment is to adopt a forward-looking approach. My work is centered around real world and businesses and not looking at stock prices on the stock market every day. Looking at stock prices doesn't tell you much about the company. It's also mostly mostly not on what has happened, but more on what is coming. Historical information like financial statement and charts tells you how well the company has performed, but it will not tell you how well you will do in the future. Next, I want to share a bit on the understanding of volatility. Most people treat volatility as is something really bad. Is it so? So this is a 1-year S&P stock chart. It's a big volatility of plus minus 30%. To me, volatility in the market only show one thing, that people have conflicting views or opinions of the stock market or the stock itself. That's why the prices move up and down in a big way every day during uncertain times. It's not something to be afraid of if you know what you are doing and if you understand the economy, the market, and the companies you are buying into. You might have heard of it before, but it's true. The stock market is the only place on earth where people don't like sales. Yeah. So to me, volatility is a welcome event, as we'll be able to take advantage of the mispricing. It's like a big sale, like all the Lazada, Shopee, 1111 sales or the 2222 sales. That's why I always ask my client to top up their investment during uncertain times, even though their portfolio might have just dropped 20-30%. This is because we know the sell down is just temporarily. So this chart is a proof of what has happened over the last 20 years. There's lots of crises and volatility. Lehman Brothers crisis, the European Union crisis, the oil crisis, the Brexit, Trump trade war. COVID is somewhere on the right side, and we're still breaking record high on the S&P 500, right? And it's not just the last 20 years. 100 years of data shows that the S&P 500 ETF return is about 6 to 8% annually. So the caveat is, if you must remain invested through the up and down. So to me, what is easier, to stay invested or surf the up and downs in the market? For me, I like to stay invested mostly, as I know I can get the results I want eventually. So let us revisit this slide where we can map volatility to real life returns. My clients was able to sit through all the past 36 months of volatility, as I mostly stay fully invested throughout. The portfolio experienced at least 5 times or more of about 10% correction and about 2 to 3 times of about 20 to 30% correction. But they all come out in the end with above average investment returns. Emotionally, it's really hard to stomach when you see stock prices drop every day. Fundamentally, if you don't know if the price drop is justified, you'll be worried if you have not been able to follow closely on the company's fundamentals. So in summary, it's easy to overreact, like buy in greed or sell in fear. But who say making money was easy? First, you must be able to pick the right companies to invest in, and after which you must accept volatility to earn the rights to make above market investment return.
Wow, Ryan, I think that was well said, especially when you said that, investors would actually like volatility because of the drawdown. It presents like an opportunity, like some sort of fire sale that, people can actually, put in more as well. It's opportunity in crisis. I think
Exactly,
I
yeah.
sort of agree with that, right? So, of course, not all investors sort of can, stomach this kind of volatility. Of course, is based on their own risk appetite, right? But why would you still feel that equities is your favorite out of all asset classes?
Yeah, maybe we can look at this slide. Yeah. So the chart here shows the different asset classes return over the long run in recent times. You also show the power of compounding. So basically, if you put 100,000 into investment, and these are the returns after 30 years. So investing in fixed deposit at 1% will turn your 100,000 to 134,000 in 30 years. You get back 1.3 times of your investment, and you make about 34% in 30 years. So investing in insurance and property at about 3% a year return will turn your 100,000 to 234,000 in 30 years. So that's about 2.4 times. And if you have invested in the S&P 500 ETF and do nothing and just hold on to it, right? Your return at 8% will turn your 100,000 into 1 million. That's 10 times in 30 years. If something can return your money at 12% a year, you turn your 100,000 to 3 million. That's 30 times returns. And at 15%, your return should be 66 times after 30 years. So as could be seen, depending on the asset class you choose, your return will be very different in the long run. And you will determine whether you can draw out 2,000 a month for your expenses when you're retired, or whether you can draw out $20,000 a month when you retire. Therefore, stock has proven to be the best asset class by far in the 100 years of data we have. So even compared to Singaporean favorite asset, right, the property, 45 years of data shows that the Singapore property underperformed global stocks by about half. And the difference will be even greater when compared to US stocks. So here is some food for thought. Have you ever calculated your total annualized return on total investment? Meaning you take all the money you have for investment and calculate your returns. It's not just a trade or an account, not a few weeks or a few months, but over a few years. Only when you do the calculation, you know that whether you are doing justice to your money over the long run. Some people can make money on the trade or in a month or a few months on a small portion of your money. But it's really hard to do it with all your money in a consistent manner year after year with meaningful returns. So do the calculation. So if you have not earning about 6 to 8% return consistently on a yearly basis for your total investable asset, you should be doing something about it. Investment in equity portfolio is long-term and diversified. You can include most of your cash which you do not need in the short term for investment. It is only then that you can grow your wealth in a real and meaningful way. Right? Warren Buffett suggested that normal people should have 90% of their money in stocks. And the world's biggest sovereign fund, the Norwegian sovereign fund, has 70% of their money in stocks. So in summary, in my opinion, most people should have at least 50 to 70% of their investment in stocks. Ethan.
Yeah, Ryan. So I think you brought up a very good point on the slides where there's the exponential increase in the different kind of asset classes. Wow, it's stellar to see there's 66 times of like a fixed D and other things that are of course not equities related. And I think you brought up another good point, which is saying that investing is like a journey. It's not like a one time thing where you make a trade or you sell something, you earn that kind of money in one event, specific event. Actually, it is about growing that portfolio and your retirement nest egg, like which many people would like to call it, right? So let's move on to the next section where we talk about disruptive technologies and growth stocks, right? So Ryan, why don't you share with us on how you do it?
Yeah. So here I want to share more about disruption technology. So and to explain what is a disruption, right? Tony Seba from Stanford did a great presentation about the topic in 2017. So this is year 1900, and we are looking at the Fifth Avenue of New York City. This is a major road in a major city. Transportation then is mainly horse carriages. So can you see a car there? There's a car somewhere around there. So that the car is over there. So there's only one car in 1900 on the street of New York City. So how long do you think it takes for the whole road to be filled with cars instead of horse carriages? So this is 1913 in New York City. The whole road is filled with cars. It takes only 13 years for the revolution. Can you still see any horse carriages around? So actually there's still one left. It's over there. So next we fast forward to 1985. Shortly after the first handphone was invented, McKinsey was hired by AT&T to predict adoption rate of handphone in 15 years time in year 2000. So McKinsey predicted 900,000 after some serious studies. Come year 2000, the actual number is 109 million. From almost 0 to 109 million users in 15 years. That's what we call a disruption technology. It disrupted AT&T landline business significantly, as they have grossly underestimated the speed of adoption of handphone. Here are two more examples of companies disrupted by technology. First, we look at Kodak. Year 2000 was a record year for Kodak, but by 2012 it filed for bankruptcy. And actually, they were the one who invented digital camera. So the reason why Kodak did not pursue the digital camera technology, even though they invented it, is because the print was their main business and cash cow. To them, it's pretty silly to kill a proven business over new tech with no viable business model. You can't be just selling digital camera with no recurring revenue. But once a disruption has taken place, you cannot hide from it. It took them about only 12 years from market leader to record business to bankruptcy. Next, we have Nokia. It was a global leader in 2007, and the story is the same. In 5 years' time, they are almost bankrupt, and they were bought over by Microsoft in 2013. Not so much for the business, but for the patents. That is, in essence, disruption technology. It is almost always underestimated and can change our life and disrupt existing market leader in a short time frame. So if you have been depending on financial statement only to do investment, you might have bought some of these companies before they experience major problem. Who would have thought a market leader would go bankrupt in 5 years? This is also the main reason why there is such a big valuation gap between value and growth stocks. In the Singapore context, right, you can look at the people like Keppel, their offshore oil and gas business, and also Sam Marine, right? That is pretty much what we are looking at.
Thanks, Ryan. I think you shared a very good point on Keppel Corp and Sam Marine as well. You know, back in maybe let's say 10 to 15 years ago, you know, when you talk about Singapore stocks, Keppel and this Sam Marine or even SIA will actually, you know, pop up in people's minds because these are the, you know, the blue chips that people are confident about, at least investors, right? So I think you also got a good point that, you know, market leaders back in the day, like Nokia, I still remember we had that, you know, those Nokia phones that just are indestructible. Can you remember that as well?
Yeah, exactly.
Yeah, way before the
that.
iPhone.
Yeah,
way before the iPhone. And I remember I had my first iPhone and it was a revolutionary product. And little did we know that iPhone actually paved way for a lot of these phones that we have today, all touchscreen. So I think that this last 10 years, right, you're right, technology has really grown so far exponentially, and a lot of those companies will actually be disrupted. So I think right now, let's move on to how you actually identify these good growth companies. Could you share with us, Ryan?
Yeah, sure, Ethan. I'll do a quick rundown of the typical steps required to identify growth company. So I do I adopt what we call a top-down approach, starting with all the future trends that is taking shape in our life, such as green energy, longer lifespan, automation. After we look at the various industries in each of these trends. For example, for green energy, you have solar, wind, electrification as some of the key industry. After looking at all the industry within the trend, we will analyze the various business model, such as eBay versus Amazon, Samsung, Intel versus TSMC, and also across the various supply chain within the sector. For example, for solar, right? Do we invest in solar farm, the rooftop solar companies, the materials companies, or the panel assembly company within the solar industry? Next, we'll look at the product service offering of each company, right? Such as product specs, the price, the quality, and the design. Followed by the competitive advantage of the company, such as technology, scale, design, and patents. We also look at management, company culture. After which, we'll do the financial analysis. The financial report analysis is done here to look at profitability, liquidity, and balance sheet strength. Lastly, we look at the valuation by calculating fair value of the company. So is that all? Not really. Yeah, there are still secondary considerations such as the economy, geopolitical, such as trade war, regulation, such as how regulation affect technology, with privacy regulation, anti-competition regulations. We also have to consider forex effects and also effects of other industry. Example, how self-driving car will eventually affect the insurance industry, or how e-commerce affect transportation. So is that all? Actually, there's still some more steps we have to do. The last step is to analyze how much to buy and sell, when to buy and sell. Right? This will be based on portfolio management by considering factors such as strategy, risk management, economy cycle, and execution. In general, there are these are the three phases of analysis. And all the sub-steps required before you can decide whether to buy or sell a company stocks. So just to touch on how we do that in real life, right? This is a case study I would like to use. So what about Tesla? It's one of the most fiercely debated company in the stock market today. Most people treat it like a punt stock, like GameStop or AMC. But is it the case? I think there is a difference whether you just got to know Tesla in the last 1 or 2 years because of all the hype about Tesla, or you have been following the companies for the last 8 years. I've known Tesla since 2013 when the Model S was launched, and I went through the base research on Tesla according to what I've just shared just now. And I concluded it's worth taking a look. But it was not until 3 years later in 2016 that I started investing in Tesla. The reason was simple. I needed Model S to be proven on the road for reliability for at least 3 years, as Tesla has just started making a car. And for the Model 3 to show that Tesla can scale into real meaningful production volume per year. It took me 3 years to decide to invest in Tesla. And at that point, most people haven't heard about Tesla in 2016. As of today, there's still a lot of skeptic about the company. So let's take a step back to understand why electric vehicles and what is the potential. This is a chart of the green sources of electricity in North America, right? It can be seen there, the cost of energy generation in North America, the green sources of electricity, such as the wind and solar, are now on average lower than fossil fuel energy. And this chart is as of 2017. So what does this mean? It means that electricity will be the greenest and the cheapest source of energy. It also means that all vehicles will be electric eventually if the EV technology works out. As it is, quite a few European countries already have a deadline to ban fossil fuel cars by 2035. Singapore too. As such, the potential is huge. Globally, there's about 1 billion internal combustion vehicles to be displaced or replaced. In 2019, total global electric vehicle sales is about 2.1 million. So here you are looking at about 500 times of growth in total market size. That is what the potential is about. So there are some additional considerations besides the base research we have just done. First is the solvency, right? Even though a lot of people is always worried about Tesla going bankrupt, but Tesla has never had problem raising capital through debt or equity issuance. As of today, He has about 18 billion in cash or equivalent, and he has the strongest balance sheet among the US automaker. Profitability. The targeted gross margin of 23 to 25% always seemed very far during the initial stage of Tesla manufacturing. Average margin was nearer to 15 and 17% then. There's a shortfall of about 7%. But today, gross margin is about 26%. I think this is a very important part. We look at the business model. First of all, Tesla is a 100% electric car company. So what do we mean by that, right? Versus other traditional auto company, it does not have legacy factory or equipment to write off when we go on to 100% electric vehicle production. Secondly, it sells its car through online direct sales. It takes about 3 minutes to buy a car, and there's no middleman sales cut there. Thirdly, it has zero advertising or marketing costs, as the car sells itself through social media and referral from existing clients. The fourth point is that it has the lowest cost battery. It's important as battery constitute about 50% of the cost of an electric car. Lastly, it's still at the initial stages of a full global scale-up. That means that the economy of scale is in front of the company, and the cost can only go down further. The other point that Tesla Bear like to tout is that the competition is coming. But 7 years later, as of today, the spec and cost of competition car launched recently is still behind that of the 2013 Model S. And it's not just the hardware, but the software of the competition are also at least 3 to 7 years behind Tesla. Lastly, we have the subsidies boost. All the countries and states are trying to lure Tesla with huge financial and tax incentives to set up factory in their country. And the competition has been paying Tesla billions in NEV credit to meet regulation criteria. As such, both government and competition are actually helping Tesla to build their factory with all these subsidies. So with all these above mentioned advantages, it's really quite hard not to win, at least for the foreseeable future. There are so many conflicting opinions in the market, news media, analysis. Who do you listen to? Not everyone on radio or TV are credible experts. Have you checked their performance before you listen to them? Only when all the homework is done, I can buy with conviction. So cost of Tesla share for my long-term clients is about $60. Today, Tesla share is about $700.
Wow, Ryan. I think you really drilled down a lot in that one slide on how you see Tesla being, this company that, of course, everybody knows Tesla, but you've seen it since, 2013. 2013, I have to say I haven't even heard of Tesla before back then, for sure. I think Tesla really picked up, I think maybe the last 3 years, when Elon Musk started to... last 2-3 years when Elon Musk began to get more popularity. But I would agree with you that Tesla is definitely one of these disruptive companies to actually spearhead electric vehicles. Like you can see, a lot of competition is actually spurring up. Even those traditional automakers are actually coming in, like Mercedes, BMW, to make auto cars because they do not want to lose out simply. I think that is the gist of disruptive technology here. Right?
Exactly.
Yeah. All right. So I think, Ryan, you have a conviction. I like the word conviction, right? So you have a conviction that, this is actually the golden era investing. Like to ask you, why do you feel so, right? And you said the last train is leaving. And what do you exactly mean by that? Can you share with us, Ryan?
Sure, Ethan. So to me, this is the fourth industrial revolution, just before the emergence of robots and artificial intelligence or AI. Why do I say that it's the golden era? Because everyone here has worked and saved enough to invest. The next generation might not get the chance, right? By the time your kids grow up and start to save and invest, the opportunity might not be here anymore. It's like Apple isn't the world's biggest company 13 years ago when the iPhone was just launched. But today, with the popularity of iPhone, is one of the largest company in the world. Actually, it's the largest company in the world. So we don't want to wait until we see robots walking around everywhere to start investing in robot and AI. As of now, only the very wealthy people or the bigger company can afford to invest in automation and AI directly. As such, only they can keep up with the automation trend. So for the rest of us, the only way is to invest in this company. And why now? Why is the urgency, right? To me, we have a restart of economic cycle due to COVID. The opportunity to invest is now, while others are still fearful and uncertain. Everyone wants to wait for the sun to come out and the birds to start chirping, right, before they invest. But typically, the prices will not be cheap by then. Sadly, there's an exponential acceleration of technology advancement. Like smartphone only started about 12 years ago. Look at the changes here it's brought, right? The rate of technology changes will only get faster. We'll see more changes in the next 20 years than the last 100 years combined. Lastly, I think most people will live longer. Average lifespan of people will be about 100 to 120 years old actually, right? Healthcare costs will be hefty and people need to cater more to retire properly. For most people, relying solely on savings and insurance will not be enough. So these are some examples of the company that we invest in with the future in mind. Intuitive Surgical, right? The growth is about 350% in the last 5 years. Alphabet or Google, the growth is about 330% in the last 5 years. They are all technological company and we invest with the future in mind. So real investing is about looking past the short-term volatility of the weeks and months and focus on the real business over years and decades. With that, I conclude the main topics of our sharing for today.
All right, thanks, Ryan. I think the stocks that you've shown and have in your portfolio is pretty stellar. I for sure have not heard about Intuitive Surgical before, but my eyes are lighting up when I see that. All right, so I think the next important questions, not just from me but from the audiences as well. How can investors actually tap on your expertise as a portfolio manager?
So currently, I'm working with Phillip Securities, which is my partner to manage investment portfolio under the managed account services. So this is a full discretionary service, as I have full decision rights on the investment, such as what to buy and sell and when to buy and sell. Some of the key features of the managed account service is as below. So you have direct ownership of the stocks and bonds in your name. This is flexible because there's no withdrawal restriction or lock-in period. But I like to inform all clients that they should have a minimum of at least 3 to 5 years investment horizon. And it's about diversified portfolio. So we are able to invest beyond stocks and bonds actually, and to create the diversified portfolio for clients. And we actively control the investment, analyze and research on the investment itself. The objective is to grow your wealth over the medium to long term. So for example, right, compared to insurance product, the charges are very different, right? For insurance product, they charge about 3 to 5% sales charge upon your purchase. And their annual fixed fee, even though it's not stated, is about 6 to 8%. Because when you buy an insurance product, right, investment link especially, for the first year, 50% of your premium goes to the agent, right? So you divide that by 10 years, you're still paying them about 5% a year. On top of that, you still have to pay the insurance company for managing your portfolio and for the platform. So what do they invest in? They invest in the global stocks and bonds, very much like I do. And so their estimated annual compounded return is about 2 or 3%. Whereas in the managed account, we are looking at about at least 6 to 12%. Because our fee is lower, our annual fixed fee is about 0.75 to 1.5% a year. And for now, if someone open an account within the next 30 days of this webinar, we waive the sales charge of 2%.
Awesome, Ryan. So I think, of course, the webinar has not ended. Please do not leave yet, right? So I think we have come to the section of the Q&A. So let's take a good look at all the questions. Oh my God, there are a lot of questions. So Ryan, let's look at the questions, right? Okay. Wow, I don't know what to pick. There are so many questions. All right, give me a minute. Okay. Okay, I think one question is from Ivan Lim, right? I think this question is relevant to all audiences as well, right? We're going to answer this live. Will upcoming potential interest rate hikes in treasury yields affect growth stocks that you are recommending or are looking at least?
Okay, so the market fear the treasury yields a lot, but in the grand scheme of things, if you look at the 30-year chart of a treasury yield, we are still at the very bottom of the whole cycle, because treasury yield at about 2 to 3% is still considered low in the long run. Definitely there will be a spike in volatility as the treasury yields factor in inflation risk and so forth, but those are transient effect on market. You last maybe a few weeks to 1 to 2 months. Market might correct a bit, but eventually you move up again. Yeah, so there's not too much worry when it comes to growth stock investment, because the growth stock story is decades, right? It's not just the next few months or the next 1-2 years.
I think to add on your point, Ryan, earlier you were saying that your horizon is minimum 3 to 5 years, right?
Yeah, exactly.
Okay, cool. Let's move on to the next question. All right. So there's Victor here actually is asking, Ryan, can you share with us your 3 most behavioral or mental model in succeeding in the long run? I think he's actually referring to your principles and what makes you so have so much conviction in those stocks. Maybe you can share again.
I think most of the what I'm doing now is due to my accumulation of knowledge and experience from my 25 years of investment. I mean, I went through all the learning curve of doing short-term trading and so forth, right? So after a while, I figure out what works and what doesn't. So when it comes to behavioral and mental model, right, I try not to let the market affect me if I know what I'm doing. Like I say, right, in all my slides, you need to have conviction when you buy into a stocks, right? Only then when the price of the stock drop, right, you'll not be living in fear. Rather, you'll be looking at opportunity to accumulate more. Yeah, those are the things that you cannot see. If all you do is just look at the stock price every day, moving up and down in the stock market, right? Actually, you don't learn much from that. Or if you spend a lot of the time on the chart itself, right? Actually, a lot of chart is controlled by hedge funds and short-term speculator or syndicates, actually. So it's really hard to win them on that front.
Well said, Ryan. I think personally, I'd like to ask you this question as well. So prior to your role as a portfolio manager, you have done short-term trading before as well, right?
Oh, definitely. Initially, when I first started, when I was in JC uni, right, I do a much shorter time frame for investment. So to me, right, to make 5 or 10% a day on a stock is really quite good already. But over the long run, you realize you win some, you lose some, right? So overall, do you really make money from it, or how much conviction do you have when you place a trade, right? At most, you put in like 3 or 5% of your money each time. But that's not the way to grow wealth, right? In order to grow your wealth in a meaningful way, you need to be able to put most of your money inside.
I think you brought up a very good point that it's not just growing a portfolio, but it's wealth, So wealth is actually your hard-earned money, and you don't want to risk it on just like those short-term trading or just looking at charts and not understanding businesses, right? And
yes,
stocks.
correct. Yeah. So
Okay,
I
well
rather
said.
spend my time analyzing companies to make sure that I don't buy into the wrong stocks for the wrong reason. Those are the lessons which I learned throughout the years too. It's like what to look out for when I buy or choose a company. Because even based on fundamental, right, there's a lot to look out for. Yeah.
I think you highlighted it earlier in your couple of slides. Yeah. Awesome. Okay. I think another question from Timothy. How do I connect with you? And do I need to have an account with Phillip Securities? Maybe you want to answer that, Ryan.
Yeah, definitely. So it's quite simple. My number is here on the Q&A. You could either WhatsApp me or you screenshot you scan the QR code to get in touch with me through WhatsApp. And then we could arrange offline to have a chat. That would be the best way to connect with me actually. Yeah.
Awesome. Okay. You guys just look at the screen. Okay, let's move on. So Eric Go actually has this question. Given $20,000 cash, which 4 stocks are you looking at now to keep more than 15 years? If you have any idea.
Of course, I have ideas. Some of the stocks which I share just now are all good stocks which you can hold for the next 10 to 15 years. But the thing about the difference between passive investment and active investment, right, is that we do follow up on the stocks on the daily, monthly, weekly basis. So I cannot advise you whether you can keep them for the next 15 years without following through on the environment, right? I cannot ask you to buy Tesla now and hold it for 10 years. What happens if someone come out with a better battery, better technology in the next 2 years, right? I will not be there to ask you to sell. So there's a difference between active investment and passive investment like ETF. Yeah. So the only advice I can give is that you have to do your homework actually to follow up keenly on the development of not just the company, but also on the industry. And not just the industry itself, but in adjacent industry and the whole world economy and what is happening in the rest of the world actually. All this will impact stocks, like what I have mentioned in all the factors which I presented just now.
Well said, Ryan. I totally agree with you on this. Okay, next question. So Ryan, there's this question for you. Do you use derivatives like options, futures, and also both long and short positions, or are you only long equities for your portfolio?
Okay, for now under the managed account, right, we don't use option or futures, and neither do we do leveraging. So all my returns are with no leverage and it's without option and futures. So it's just purely based on investing in stocks actually. Yeah.
Wow, that is amazing, Ryan. That is really amazing. Okay, next question. By Victor, right? So this is a question where what are some of the important lessons that retail investors can practice in your experience as a portfolio manager?
One of the hardest thing to do, in my opinion, is not to be to let the market affect your emotion when it comes to investment, right? Actually, when the whole world is running scared and worried, right, it's the best time to see what you would like to buy in the market, right? And it's not the other way around. And when everyone is happy, it's a time to sell. I mean, a lot of people know this idea, but in practice, it's very hard to carry out. Yeah, because most people are more worried when they see the money dropping every day, right? So to me, the first step to achieving success in the stock market is to understand this and to put this into practice actually.
Wow, I think that's very well said, because emotions do come in no matter how much you tell yourself that, hey, you know what, it's going to be fine. But sometimes you just feel that, when you see a portfolio is red, I get that kind of feeling sometimes as well when you see, everything that is red as well. So I think that is a very good point that you have, Ryan. And I like it when you say it so calmly and with conviction.
Yeah.
Awesome. Okay, let's move on to the next question. So there's a question for you. How many customers do you actually take care of right now? And are customers with fund having more advantage, or the ones that are having less funds?
Okay, currently I have about 100 over clients. Definitely having more funds help because it helps with the diversification of your portfolio. The more money clients passed to me to handle, the more diversified a portfolio I can assemble for them. When you have more stocks in your portfolio, it mitigates the risk. So it helps in the risk management of the portfolio construction.
I think that's a very good point, Ryan. Okay, next question. I think this question is on a few of attendees' mind as well. Do you cut loss for your customer?
Oh, as I mentioned, right, the only time when I cut loss is when the fundamental of the company has changed. But it's definitely not due to because the stock price dropped a lot, 30-40%, right? Then I cut loss. I will not do that so long as the fundamental of the company has not changed. So when the fundamental of the company has changed, no matter where we are in terms of positioning of the company, I will still sell because the real world and businesses has changed, right? That's why we have to keep it up. Yeah. So we try not to be controlled by emotion. That's what I'm trying to say all the time. That all the decision making is based on a logical judgment, and after all the work that we have done, then we make the call to buy or sell. Yeah. It's not affected by whether after we buy the price drop a lot and then we try to cut loss. Yeah.
Ryan, I think you just reinforce your conviction as a portfolio manager. Awesome. Next question. NG actually asked, Tesla just announced its Q1 results. Almost a quarter of the Q1 profits came from the sale of Bitcoins, right? Very lucrative for 1 month investments, better than selling EVs. Her question, what kind of message did Tesla and Elon Musk want to convey to the market?
So I think a lot of people has problem trying to understand what Elon is doing. And he stay in. So if you have listened to the earning conference call, right? He did answer that question that he sell the Bitcoin about 100 million, about 200 million of it, in order to test the liquidity of Bitcoin. Because the only reason why they buy Bitcoin is to put some of their cash, to find a place to hold their cash, but they need the liquidity. So in order to test whether this works for them, they sell part of the Bitcoin to see whether they can sell the Bitcoin fast enough when they need the money. So that's the main reason why they did a partial sale of the Bitcoin to lock in the profit. It's not because to beef up their earnings. Yeah. Another thing I want to highlight is that a lot of people always say, Tesla profit is mostly from selling EV credit and all that. But what they don't realize is that why would a company that is still highly in expansion, in doing expansion, want to show the world they're making a lot of money, right? Would you do that? That the day when you disclose how profitable you are, you'll be paying taxes, yeah. And the corporate tax in US is not low, yeah. So if I'm a owner of a business, I will keep the money and invest them and expand them as costs, right? Until the day I stop growing, when I have nowhere to put my money, yeah. Then I'll report those as profit, and then start paying taxes to the country actually. Yeah, but at the growing stage, right, like what Amazon did in the early stage of its business, for the first 20 years, you don't see any profit from Amazon because Jeff Bezos doesn't want to pay taxes, period. Yeah.
Wow, I think that's a very good point. Especially during Biden's presidency, they are, proposing to increase corporate tax, especially in this kind of administration. Very good point. All right, let's move on to the next question. So anonymous attendees actually asked, if I still hold Keppel / Sembcorp Marine, Sembcorp shares, what should she do? If she sell, she's going to incur big losses. Should she actually average down or buy more at current prices? What do you think, Ryan?
I think my advice is definitely not to buy more. To sell or not very much depend on your conviction of holding them. To me, the why Keppel Corp main business, which is oil and gas business, and Sembcorp Marine business has been going down, is because we no longer need oil in the future. So as COVID reside and the world economy picks up, we might see oil price going up in the next 1 to 2 years. But we are never going to see oil price stay elevated above $80 in the long run. And for this company to have a future, I'm not too sure about Keppel Corp because they already sort of like given up on the oil and gas business. But Sembcorp Marine in particular, the oil and gas business, the offshore marine business will never come back. The reason is that when oil price stay below $80, there's no need to drill oil from the sea. Yeah, which is why you see Saudi Arabia trying to lease Aramco, right? The only reason why they have not done it in the last 50 years, right, but why they want to lease Aramco now is because they don't want to hold on to the oil anymore. So they are trying to lease it and make other people buy their oil asset. Because oil will stay in the ground for a long time to come. Eventually, oil, I think, in my opinion, will stay below $20, $30 actually. Yeah.
Wow. Okay, thanks for sharing, Ryan. So let's move on to the next question. So I think this question is by another anonymous attendee. Can we use SRS funds to invest, and is there a minimum investment amount?
Yes, you can use SRS to invest, and the beauty of using SRS to invest in the managed account is when you invest in SRS yourself, you can only buy Singapore stocks. When you use SRS to invest into the managed account, I can buy global stocks for you, and not just stocks and other asset class too.
Wow, I think that is definitely a pointer there, right? Okay, next, anonymous attendee again. Is Phillip's managed portfolio managed by a team or individual brokers?
Okay, first of all, we are not brokers, we are fund manager. And for me, right, I have my own team. My work with Phillip Securities is in partnership. So Phillip has their own in-house managed account managed by their Phillip in-house team. But for me, I have my own team. So we use the Phillip platform to help clients manage their funds. Yeah, so it's different. So the managed account services is split into whether it's in-house or whether it's an external fund manager like myself. Yeah.
Okay, cool. Thanks, Ryan, for sharing. I think another question from Victor. What's your knowledge or your source of equity ideas in identifying these future themes?
Yeah, so we generally look out at all the news that comes out. We listen to earnings conference call. We look at the industry publication. We get all the ideas by reading widely, and to zoom into all the different aspects of a business and trends itself. So that's the only way that you scan enough items or find enough places to get investing ideas from. And after we get the investing idea, then we try to zoom down and do deeper research into it, according to what I've just mentioned, all the different steps.
Thanks for sharing, Ryan. All right, let's see another question. All right, so this question is from Howard, right? So what sector do you actually think will do well next, given that there's a cyclical rotation?
I think I have mentioned that in my radio broadcast in the last few weeks. I did 2 or 3 radio broadcasts. I mentioned that we are in the stage. It's still early stage in the new economic cycle. In this stage, right, like what the audience is mentioned, there will be some rotation. It's hard to pinpoint which rotation will take place at which particular week or month. That's the typically how it works out at the initial phase of this economic recovery. So those are the short-term trading I mentioned about. It could be some tactical positioning that we could do to take advantage of, but this is not the main theme of my investment. But just to give the audience a sense, right? Actually, most stocks will go up in the next 1 to 2 years. Basically, because we are at the beginning of a cycle. Yeah, it's like a rising tide will raise all boats. So long as you don't buy into highly speculative counters that is already highly valued, then your chance of making money is quite good in the next few years if you stay in stocks, actually. Yeah.
Wow, Ryan, that's I love your conviction on that. All right, we have a few more minutes for the last question. So this question is asking whether you look at Chinese stocks or the Chinese stock market or just US stocks in general.
Okay, for my portfolio, right, I'm most focused in the US market because they are the most efficient and transparent market in the world. They have a very good regulation, meaning that the companies are well regulated, and they have the best company listed there, which is why 80 or 90% of my portfolio is US centric. I have about a few percent in Singapore, about 10% in Hong Kong, a small percentage in Europe, but not much. Yeah, that's roughly my composition of the portfolio now in terms of geographical allocation.
Wow, Ryan, that's exceptional. All right, so I think we are a bit short on time right now. It's 9:01, right? If you have any more questions, please just text Ryan. His number is 83233882, right? So I think we're a little bit short on time. Thank you everybody for joining us for this insightful webinar with our portfolio manager Ryan Tan. So Ryan, thank you. Yeah, thank you once again for appearing and speaking for our webinar, right? So if you have any questions, please just text him. He's one text away. All
thanks,
right,
Ethan, for having me. Yeah, inviting me, and thanks everyone for your time today. Yeah.
Thank you, everybody. So this webinar will be recorded and it will be on YouTube Live. So do stay tuned for our next webinar in our series. All right. So we'll catch you the next time. Goodbye, everybody.